Hi, this is Daniela Cambone, and welcome back to StansberryInvestor.com. Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside, like Riot Blockchain before it shot up 10,000%, Digital Turbine before it shot up 789%, and Overstock before it shot up over 1,000%. This power gauge comes from the legendary Mark Chaikin. And right now you can get a free in-depth look at how his power gauge system works. A way to type in any of the 4,000 different tickers and see exactly where the stock is most likely to go next and in any type of market. Simply go to powergaugetrial.com for your free look. Again, that's powergaugetrial.com for your free look. All right, let's get to our segment today. Hi, this is Daniela Cambone, and welcome back to Stansberry Research. Today we are talking about the yield curve, which is speeding towards inversion. So what should you know about this? Joining me today on the show is Alf Peccatiello. He is the author of The Macro Compass, and he's also the former head of a $20 billion investment portfolio. Alf, so nice to meet you. Welcome to my show here.
Ciao, Daniela. It's my pleasure to be here.
Well, my pleasure to get your thoughts because one of your recent tweets really stood out for me, and I just want to pull it up here. You said, look, Powell just told you, 50 basis points in May is very likely, now a 61% chance priced in. And you were kind of poking fun at mainstream media saying, now cue the flashy headlines about a reverse yield curve coming. Why poke fun at this? Are you saying that is the media going to over-exaggerate this, or is there truth here?
No, so as always, the yield curve inversion has actually already happened if you look at the right metrics, and some portions of the yield curve have been inverting already a month ago, as I pointed out on my newsletter, for example. If you look at a specific curve, which is called the OIS curve, Overnight Index Swaps curve, which is actually a clearer indicator than the Treasury yield curve, you will immediately understand that the 5-year against 10-year slope of that yield curve inverted in February. And why is that more relevant? It's because that curve only reflects the future path of federal funds rate, while into treasury yields you also have other components like balance sheet, regulatory constraints, etc. So this clearest indicator of the yield curve already inverted in February last year. But the interesting part is that now the treasury yield curve is also starting to invert, and therefore public opinion and mainstream media are going to try and jump all over it. And I expect Powell to receive plenty of questions at the next Fed meeting, where I expect him to deliver 50 basis point hikes, which are likely to increase the short-end yields and possibly make the curve even more inverted. And therefore, he's going to get a lot of questions about it.
And the question's going to be, since the 1950s, every time that the yield curve has inverted, it has triggered a recession. So if you're saying that trend has already begun, well, first and foremost, do you think it will trigger a recession again?
So my expectation is that US growth this year will disappoint pretty aggressively. A definition of a recession is 2 quarters of negative growth back to back, and that I think it's too much as an assessment. Do I think economic growth is going to slow down? Yes. Do I think it's going to slow down more than expectations? Yes, it is. But the point here, Daniela, is that the Federal Reserve actually wants that to happen. It was very surprising to hear Powell, who literally said, I need to slow down things here, guys, because inflation at 7.5%, and on the supply side of things, it doesn't have an impact. If ships are not going through because China is applying a zero COVID policy, and if commodities are not available because Russia and Ukraine are having a war, the Fed cannot do much about that, right? But what they can do is to slow down the economy on the demand side, and I think is very committed in achieving that by raising interest rate above neutral levels. Above neutral levels literally means I want this to slow down.
Okay, above neutral levels, but will it be enough, Alf, or is the Fed just too behind the curve here to catch up and fight the beast?
So I can tell you, I think what they're looking at. I made a study on inflation expectations because one thing is today's inflation, but the Federal Reserve doesn't want to lose control on what you and I think inflation will be, because ultimately that drives consumer expectation and sentiment and borrowing activity, etc. And if you look at inflation expectations, over the next 5 years, the consumers expect inflation to be 3.5% in America. That's higher than the Fed target, but especially it expects with a certain probability large inflationary prints to come. And this probability is not negligible. The tail of this distribution is getting fatter, and they don't like that. They really don't like that. They want to keep inflation expectations under control. And so they maybe feel a bit behind the curve, I believe. And that's why you hear Powell being aggressive, then more aggressive, then more aggressive in his speak, because he really wants to convey the message that inflation is enemy number 1, 2, and 3, and they're going to make sure that the enemy is tamed. So I think they're really going to try and be aggressive here.
Okay, so the question is, okay, we now know inflation, like you said, enemy number 1, right? 2 or 3. The question is, are they going to be able to orchestrate a soft landing here? I mean, what will happen to the stock market?
So as a former fund manager, instead of telling you what I think, I'm telling you what are my positions. So my positions are public. People can see them at the Macro Compass. It's my free newsletter. So I am short risk assets, equities, the Russell 2000 as an index, and I am short high yield corporate bonds. And so those are, I think, the very vulnerable parts of the equation, because those are the Russell is composed of small cap cyclical stocks. They need earnings to be strong, Daniela, in order to perform. And I don't think earnings will be strong in this environment. High yield junk bonds, basically, those are very high levered companies that need to refinance. And when they go and refinance at higher rates, they actually have a big problem. So what I'm telling you is, when they hike above neutral rates, which literally means above what the economy can take, that's literally the definition, they are literally trying to slow down things. And so the weakest links in the economy, over-indebted companies that don't have a strong balance sheet, that cannot produce strong earnings, I don't think they're looking good here, to be honest. What I think actually a sound investor should do in this environment is try to be more defensive, increase the cash allocation, which sometimes can serve as a cushion against this risk-off environments, and just try to be more defensive, and if possible even short these highly cyclical, highly levered up companies out there.
Okay, so let's talk about this diversification, right? What are sectors you do like?
That's a great question in this environment. So I would say there are a few places where I think a medium to long-term investor can seek shelter in this environment. One is what I call high-quality stocks. So there are a couple of ETFs there that incorporate companies that have certain features when it comes to balance sheet strength. These are companies that are not highly levered, that are so-called low beta companies. So they tend to follow the index, but in a less aggressive way than other companies, like highly valued companies. So I'm talking about pharma, staples, for example, this sort of companies. Some of them tend to have a pretty decent balance sheet. So if you really need to be invested in the stock market, I would prefer to look at these high quality companies. And geographically speaking, the other place where I think arguably a medium-term investor can find value, especially after the latest drawdown, is China. And the reason why I say that is that, first of all, the market has gone through a large deleveraging over the last year and a half, starting from the Alibaba of this world and then ending with the real estate sector in China, which was really hammered down. But Xi Jinping and the PBOC in China are telling investors they want to make sure things are contained. So they're starting to ease. You see Chinese credit impulse picking up a bit. Xi Jinping has a Politburo, a very important Chinese politics meeting in November this year. I really don't think that he wants to go there with his stock market and his economy looking like a wreck. So if you're a long-term investor, there are some opportunities in China too. And if you want to keep investing in the US or the European stock market, I would rather focus on high-quality, strong balance sheet companies.
What do you do with tech stocks here?
Great question again. So tech stocks are, again, there is a dichotomy. Tech stocks are either monopolist companies, let's say, that have created a very strong business model. And some of these companies actually, despite relatively high valuation, I think they can do okay in this environment. So we're talking about, let's say, the mega cap tech stocks, most of them at least. And then there are the more aggressively valued tech companies, the ARKs of this world, right? So the ARKs of this world, to be honest, I don't think they're looking egregiously well in this environment. Other tech companies that have a stronger balance sheet and a stronger business model, I think they can be investable. Nevertheless, it wouldn't really be the first place I would look into because of valuations. Overall valuations are not going to be supported by such a macro backdrop.
Alf, since it's the first time you and I are speaking, I'm curious to get your thoughts and stance on the commodities sector right now. What do you do with
Yeah.
commodities?
So commodities, a very interesting sector. Long term, one has to argue that there are some commodities that, because of the ESG transition and because of the underinvestment that some geographies like Europe have. I mean, I live in the Netherlands and I'm Italian, and in Europe, we actually lack most of the commodities that will be necessary for the green transition, and our politicians are trying to push that strong, right? So, copper, aluminum, for example, nickel. These commodities are necessary for ESG transition. We don't produce them, we will need to consume them. So obviously, you can imagine there is a long-term mismatch that benefits some of these commodities. That's the long-term story. The short-term story is that these commodities basically are very scarce. Some of those are very scarce because of supply bottlenecks. An example is Ukraine actually exports 90% of global neon. And neon is a gas which is basically used in chip making. And chips are in everything we use, guys. I mean, computers, medical devices, cars, you name it. So obviously, when there is an impaired big producer, you'll have a spike in price. Now, short term, it's really difficult to assess where these things are going. Ultimately, it's a geopolitical call in most cases. If you think geopolitical tensions are going to ease, then these commodities are priced to be very expensive. Otherwise, they can continue to rally.
I know. I mean, especially if you're looking at, look at palladium, right? Russia, a net exporter, producer of palladium. I mean, any thoughts or sentiment on what it would do here?
Yeah. So if you look at palladium again, it's basically a call on the Russia-Ukraine war, right? I mean, if you
Right.
think there's going to be a negotiated outcome
Right.
soon, then hostilities will stop, and therefore Russia will be able to produce some of this palladium. Nevertheless, the sanctions are
Exactly.
something that is likely to stay going forward. So you can make a case that there is a structural investment to be made in some of these commodities that are important for the long-term ESG transition.
Yeah.
And on top of that, Russia will be an impaired supplier for a while.
What about the safe haven play of gold?
Gold. All right. So I have to say that I've been truly impressed by how gold has remained strong this year. Well, of course, the war, let's say, helped the flight to safety there. But Daniela, if you think of a Federal Reserve which is hiking rates really fast or promising to do so really fast and unwinding monetary policy to make sure that inflation expectations become tamed again, then what you're really doing here is you're making investment in short-term dollar instruments more attractive, which naturally makes gold less attractive as an alternative for the medium-term asset allocator. And nevertheless, gold has held up very well. Now, going forward, if you live in an environment where you expect the Federal Reserve to bring short-term bond yields to 3%, 2.5%, 3%, and you expect them to succeed to lower inflation, then real interest rates are obviously going to go higher, which makes the attractiveness of gold not great going forward. So it's not an asset I'm short right away. I own gold in my long-term portfolio. Tactically speaking, I actually think it's just, an asset that could be weaker, but I'm not very convinced about it.
Let's round things up here. Let's just throw in Bitcoin. You say, I look at the digital asset space, Bitcoin and company, as a macro asset class. You got to admit, it's been extremely resilient given the macro circumstances. I'm still short and in the money, but we'll pair back to position if it hits 46K. What role does Bitcoin play for you?
Yeah, so Bitcoin is as any digital asset, I tend to look at those as an asset class, right? I'm not a maximalist and not a denier. So I own a small percentage of Bitcoin in my long-term portfolio. It's 2% of my wealth. And I think Bitcoin, as any other digital asset class, benefits from a structural tailwind of technological developments we're in, and potentially, Daniela, plays also a role in a new monetary system if we ever go towards, let's say, a monetary system which is not based on credit creation like today. So today, any commercial bank or government can decide to create new spendable currency without it being pegged by any hard asset, like it was the gold standard until 1971. If you have to imagine another monetary system where you want to peg credit creation to something else, you might imagine digital assets, scarce digital assets, to be in the mix of considerable hard assets to peg something against. So because that is a probability, and because there is a technological long-term tailwind, I like to own some of it. This is long-term. Short term, obviously, it is also a relatively speculative asset where if risk sentiment increases, people go long Bitcoin, otherwise they buy less Bitcoin, right? So I thought because of the dampened risk sentiment given the Federal Reserve actions, Bitcoin would suffer more. And it did suffer, but I think it's been very resilient to all this environment. So I'm considering cutting my shorts and go back to neutral more or less when I enter the short, because the macro story is not playing out and Bitcoin, like gold, is holding up very well.
All right. Well, I guess just to bring it home for us, Alf, like I said, it was the first time we're speaking. Given the no shortage of geopolitical uncertainty that we're facing, what would you tell our investors and viewers back home? How do you navigate these waters right now?
So I think if you're an investor, what you're trying to achieve is to preserve your purchasing power over time, right? You want your savings to be worth what they're worth today and possibly a bit more over time. That should be your objective. So if you look at all these uncertainties down the road, in general, it's always good to think about tail risks hedges. So we have seen, for example, that commodities can become scarce all of a sudden, right? So people have to consider these tail risks events and own some assets that can protect you against these tail risk events. That's the reason why I own gold in my portfolio, for example. That's the reason we have seen now why owning some commodities might be a good hedge against certain tail risk scenarios. So you should design your portfolio in a way that benefits from long-term growth, because guys, the world is not going to end tomorrow, so you need something that exposes you to cash flows, to earnings. That's mostly the stock market. But you also need something that defends. You need defenders in your portfolio. So always try to think in probabilities and in risk scenarios, and make sure you have some tail hedges as well.
Yeah, and just getting back to your point about having some cash and liquidity on hand, so you can obviously go in and scoop up some deals. How much cash should one have in their portfolio? Like, how do you figure out that percentage?
Yeah, so what I normally tend to do when I look at my portfolio is I look at my risk appetite. And so I define what are my objective in terms of returns and how much drawdowns I can take without doing stupid decisions. Stupid decisions generally means getting out of every investment because you're afraid something really bad is going to happen. And when you do that, what you're doing is you're refusing to be invested over the long term. That's, generally speaking, for a long-term investor, not a very sound decision long term. So you should design your cash allocation in a way that you are going to be able to afford drawdowns without freaking out. And I can give a prescription, because any risk level, any risk appetite from any investor can be different. In my case, I would say if I increase the cash allocation from 10 to 20%, I feel that my drawdown will be much smaller, and therefore I can handle the situation better.
Alf, I really appreciated your time and your thoughts today. Come back soon.
Oh, I will do that. Thanks, Daniela, and thanks to the listeners as well.
And thank you all for watching. We'll have much more coming your way on Stansberry Research, so be sure to stay tuned. And don't forget to sign up for premier content you can't get anywhere else at danielacambone.com. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.